Hey, welcome back to Two Stupid Guys Try Stocks. I'm Dylan.
And Anthony?
And we're going to take a look at a couple things. The market took a decently drastic dip, and the inflation data that came in was good enough. However, I think people are missing the real story on what's about to happen, and I'm in the minority on this. So I am sorry if I'm wrong. But let's get into it. I'm also going to show you exactly what I'm doing with my investments and how I'm utilizing TLT. Here's the really surprising stuff. So there's a guy from Morgan Stanley, and then I don't know, a bunch of other people. They're saying, "Hey, we're gonna have 3 Fed rate cuts in 2024," which I I don't know. Do you see that happening?
No, I don't
I
see that
don't.
happening. I've been very, very wrong on many of my predictions regarding Fed rate cuts, but I don't see 3 rate cuts happening this year. They have what exactly like 3 meetings left.
There's 4 meetings
Yeah,
left
four
because one
meetings.
meeting
So,
is in 3 days. So
oh yeah, yeah. They ain't gonna do anything at this next meeting. I know the market CME data was looking at September, maybe one, as of most recent before this data came out. So
we're gonna take a look at some PCE data here, but I think people are missing stuff. So obviously, I get it. It's good. Hey, the PCE came down. We're at 2.5%. We're in line with what we were expecting. Yada yada yada. That's fantastic. But oh yeah, this is your
yeah,
thing.
Yeah, I saw this summary in the CNBC article, and this is like my favorite summary of the PC data here. It just says the report in a two-word summary is good enough. All right, that's basically when it's 2 a.m. at the bar and you're just looking around to see what's left. You just look around and say, "Nah, good enough." That's basically what they're saying at this point. But spending is good enough to maintain the expansion. Income is good enough to maintain the spending, and the level of PCE inflation is good enough to make a decision to cut rates by the Fed. I mean, that's a very succinct summary of this entire thing. Is that okay? Like the data looks reasonable. They're probably going to start to cut rates. I still don't think they're going to be super aggressive out of the gate. Powell has been very, very emphatic about that. Like cutting too soon is more dangerous than anything else he can do. So he's going to start to cut probably like soonish. I think September is a reasonable estimation right now, but he's not going to be aggressive about it. No 3 rate cuts.
I completely agree. Here's why I agree. So the June, can you see my mouse? Yeah, okay.
Yeah.
So I get it. A lot of negative numbers. All right. You want a lot of negative numbers, but look at this big negative number followed by May. All right.
Yeah.
Now, energy went insane for a while. Like, look at this 10% jump in August.
Mm-hmm.
Just wild. I think people are thinking that inflation as a whole is coming down, but really it's being kind of, I guess, bolstered by energy, big
Energy coming down.
decreases. Yeah.
Yeah.
I
Which is
think
why
this
you see
last,
headline inflation right now is at 2.5,
yeah,
but core PCE is at 2.6.
yes.
That's why.
And I think that point 0.5, point 0.6 is going to be really sticky. I don't think it's going to be as easy as people are assuming. I understand that it's close to 2, but the closer you get to the goal, the longer that little bit's going to take. It's not like it's not like when we were at 9 or whatever it was, something crazy, and we dropped to 7 super fast. This
Yeah.
last bit is gonna take a while, guys. It's not.
Yeah.
I don't know why everyone's so excited.
I agree entirely. Remember that fancy word from like math asymptotically as you approach the line but don't never quite touch it as it starts to get that like kind of like little gentle slightly
Yeah.
decreasing sloping line as it gets closer and closer to the line. Yeah, that's exactly what I expect to see happen here is month over month changes start to decrease in their size and effectiveness. But I mean we made some good progress, and from a neutral standpoint we're probably still over 1% above what like a neutral market rate would be. So there's room for them to cut it and still be at a constructive monetary environment.
I can't focus on anything you just said because I'm still trying to realize that my math teacher was correct. I did get to use that once in my life.
Yeah. Yeah.
Yeah, there you go. That's the only time though. So this is market sentiment. Take this, with a caveat, right? These are surveys. This is not, other people, I guess, put more emphasis on this. I don't, but I do think it's very important because there's one graph I want to show you. So you can see 724 here. You can see that we're above the average. The average has been 37.5. We've been fairly above that for all of July with the bullish bearish high of 50.3 and the bullish high of 52.9 with the dates accordingly. Now, look what has happened when we've hit those numbers. It usually decreases fairly quickly. And if you superimpose this on the SPY, as people get more and more bullish, there's usually a correction, which is kind of funny. Because you can see it drops fairly quickly where people are like, oh, it's going to be bullish for the next 6 months. Oh, no, never mind. Just kidding. We're wrong. So you guys know that I love the 100 moving average and the 200, all right? Now, these are just the simple moving averages, not EMAs, but this is the gray line and the blue line respectively. So you can see we had a decent hit and then a support on the 200 November. It held up in May when we hit it, and we just hit it again. Now, I'm doing the Qs and not the SPY on purpose because the Qs are more heavily weighted towards the Mag 7, which are bolstering the entire economy right now. So that's why.
A little bit.
I want to do a larger time frame, okay? This is beginning of 2021. I just want to show you how respected these lines are. So each green is a relatively within a 1 or 2% drop or exact touch of the 100. All right? It's pretty solid. It's very, very, respects it very well. Then you have your death cross, right? Where the 100, I don't put a lot of weight in these, but where your 100 actually crosses below the 200. And then this was way more than 1%, just so we're clear. It was close to the 200. But you can see it did respect it. We have 3 more hits right there. We crossed it. This actual line here, it actually touched fairly closely. We had our death cross, and then it supported again. This green one is that 200 hit, and now we're here again.
Like,
all right?
Death Cross, the second one you meant Golden Cross, but yeah.
Golden Cross. Oof. Oof.
We did a separate video on like how useless those things really are.
Yeah.
Though.
I don't really like them. That time frame actually worked, but when you went back 20 years, it did not work near as much as you'd think. But this one actually did. So here's what I'm actually doing. There's a couple comments of people asking. So this is with my 401k, which I don't have a lot in, and then my actual Robinhood account, which I do have a lot in. So this is average out completely. So 17.4% cash earned interest, 50.1 are in stocks ETFs. Because I have stuff in the Russell 2000, I have stuff just in Qs, that kind of stuff. And then bond ETFs, I'm sitting at 32.5. Okay?
Nice.
So what I'm going to do, I don't think the market is going to do well 6 months from now. I truly don't. I understand that the market is pricing in 3 rate cuts. I don't think we're going to get 3 rate cuts. It would be a stupid thing to do, especially when the economy is holding up so well to risk it. It's a very, very high risk, low reward move to do 3 rate cuts. It just is not a logical thing to do.
Just not what Powell's going to do.
Exactly. And when we don't get those rate cuts, now, guys, I don't know. I'm just guessing. But what I'm going to be doing is moving my cash reserves to more bonds. I want to sell some companies of stocks, buy even more bonds. And then, I know, but this is hefty. This is risky. I get it. And I put TLT, EDVs, whatever your vehicle is. I don't, doesn't matter. Just whatever you like. Usually, as we looked at previous videos, when we have a market reaction to rates, it goes down, bonds usually jump up fairly violently. It's usually pretty quick, and then they come back down to something more appropriate. So during that time, I'm going to then move my money back to stocks and hopefully get my stocks on sale. Perfect. So easy, right?
Yeah. Step 3, profit.
Profit. Now, what's actually going to happen, right? So the 2 likely scenarios for this, all right? There's a drop in stocks. It's modest or non-existent. I'm completely wrong. The stocks are going to be greater than the gains from the bonds, and I'm going to underperform. Very likely scenario. Equally likely, what I just said works. I'm going to say less than equally likely, but, I like having money in bonds right now for the safety because I feel like we're super overvalued. I don't think we're getting rate cuts. I don't think, hopefully we get a double top or something I can make a trade. But as of right now, I'm not confident enough to actually buy a put, which I know I have in the past, but I'm not doing it right now.
Yeah. Yeah, that makes perfect sense. I agree. I wouldn't be betting against the market overall right now. I'm actually like 100% invested across pretty much everything right now. My biggest play is like the moving towards more and more small cap allocation.
I think that's a good play for the next 6 years. If when we looked at the bond reaction to rates in like 10 years ago, because it was fairly violent, I'm not going to hold this for a long time once rates start getting cut. I'd rather just take profit and then get stuff like the Russell 2000 ETF at a much better price. Or, Google hits 120, great, I'll buy some. But, never know what's going to happen. These are the 4 dates in the meetings. Let us know what you guys think.
All right, catch you guys in the next one.